Hello, welcome to the weekly technical analysis review here at XM.com. I'm Rafa Boyajan, currency analyst, and today is Monday, June the 18th. The pairs we're going to be looking at for this week are the dollar yen, the pound yen, and the Kiwi dollar. We're going to start first with dollar yen. The pair is looking still fairly bullish in the short term, though it has seen some easing of momentum since Friday. We saw on Friday resistance coming once again around the 110.85 region. We would need to see a break above that level in order for prices to challenge that 4-month high of 111.39 from back around mid-May. Not too far above that, we've got the 78.6% Fibonacci of the down leg from 111.38 to 104.62. That's around 111.50. A break above that level would reinforce the bullish outlook in the medium term. To the downside, though, we do have immediate support coming from the 200-day moving average around 110.18, and just below that we have the 61.8% Fibonacci at around the 110 level. Drop below the 110 level would take prices towards the 50-day moving average around 109.26, and just below that we've got the 50% Fibonacci at 109. So a breach of that support level there would shift the near-term outlook to a more bearish one. Let's now turn to pound yen. Pound yen is looking rather bearish at the moment. The stochastics, we have the bearish crossover there with the percentage K and percentage D lines. It's heading downwards. If you look at the MACD, it is holding about the trigger line, but we have seen the slight drop in the histogram of the past couple of days. So the risks are clearly to the downside there. Immediate support is coming from the 20-day moving average at around 146.45. A breach of that support would take the pair towards the 23.6% Fibonacci of the down leg from 153.84 to 143.18. Below that level, we've got another potential support coming from around 144.65. If prices break that support, we could then see pound yen targeting that 8.5 months low of 143.18 from back in May, and a drop below that May low would potentially shift the medium-term outlook to a decisively more bearish one. At the moment, the medium-term outlook, although we have had higher lows and lower lows, it's looking still neutral to bearish, but a breach of that low would definitely turn it more decisively bearish. To the upside, we had seen resistance coming from the long-term ascending trend line from back in May. Of course, the pair did breach that ascending trend line from earlier in May. So that support then turned to resistance earlier in June. Before that resistance level there, though, we could have another resistance level coming from 38.2% Fibonacci at 147.25. A break above that level and a break above the ascending trend line, we could then see strong resistance coming from the 50% Fibonacci retracement at around 148.50, and also the 50-day moving average at around 148.70. If prices were to successfully break above that strong resistance area, we could then see the next target being the 61.8% Fibonacci at 149.75. And our final pair for today, the Kiwi dollar, it is looking fairly neutral for the Kiwi dollar. We can see RSI, it is in negative territory, slightly pointing outwards. If we do see a positive close today, that could potentially open the way for additional gains in the coming days. For now, though, the pair is lacking direction in the short term, at least. To the downside, we've got support at the 0.69 handle, and below that we have the 5 months low of 0.6850 from back in May. If prices were to breach that low, we could then see the medium-term picture. The medium-term picture is already bearish, and a drop below that level would reinforce that bearish structure. But if we were to see the upside momentum gaining some strength, resistance would likely come from the 23.6% Fibonacci of the down leg from 0.7394 to 0.6850. That's around 0.6978. A break above that level would take prices back towards that very strong resistance of the 38.2% Fibonacci at around 0.7058. We saw prices several times attempting to break above that resistance level from late May and early June, but failed to do so. A break above that level would help strengthen the upside momentum. It's also near the 50-day moving average, currently at 0.7045. If prices were to successfully break above that level, we could then see a move towards the 50% Fibonacci at 0.7121, and that would also help shift the medium-term outlook to a more neutral one. That's it from me. Thank you very much for watching, and have a great day.